Good morning, everyone. Welcome to the TradeXchange weekend webinar. Thanks, everyone, for joining. A brief recap of last week. We mentioned last week that the Fed will dictate the next move. What did we get? A hawkish Fed that dictated the next move. Following the FOMC meeting and the Fed commentary, it seemed like everyone on news media was against the outcome. Respected individuals with a tirade on TV over the Fed decision. Why? The Fed's two mandates are employment and stable prices. Stable prices have been broken for so long, but no one cared on Wall Street when the stock market was going higher, and individual citizens were getting hurt in every area of our economy. Clearly, prices are not stable, and clearly this is not transitory. So what makes everyone believe that inflation will subside with what has been done already? Maybe it will, who knows? But I always wondered, in my opinion, where does everyone get their crystal ball from? Maybe they bought their crystal ball from the same guy who sold Jack his beanstalk beans. Who knows? But in our opinion, we always believe, let's see what happens. All I know is that prices in our area are still sky high and nothing really has dropped. Are people talking their book as usual? Possibly. But this time around, I think Wall Street should care about the everyday citizen rather than their book, because from what we can see and who we talk to, things are not great out there when it comes to inflation. Markets are basically back to June lows. We have been mentioning two things every week to watch for the market directional move, which is the 10-year yield and the US dollar, both hitting new highs and correlating to weakness in markets. VIX as well has broken above the short-term fear level of 30, but ended Friday right below it. Rates hitting its highest level since 2008, as did long-term treasury yields. One important aspect of the FOMC announcement was the fact that many expect rates to reach 4.5% by end of year and basically to stay at these levels for much of 2023. What are we watching this week? This week is filled with Fed speakers and one key inflation report on Friday, the PCE inflation. We are watching the US dollar, yield markets, and also we need to keep an eye on Europe. Members, keep in mind, we have not seen a Fed or yield market like this in 15 years. We have a whole new set of traders who have not experienced a hawkish and a raising rate environment. Always do your due diligence and keep in mind what we always learned from Peter Lynch. Never fall in love with the stock always. Never fall in love with the stock. Always have an open mind when it comes to this market. So what we'll do now is just break down this week ahead. And if anyone has any questions after the webinar, ask away. So upcoming US and world events for this week. We do have some top earnings this week that we'll be watching. Bed Bath & Beyond, CarMax, Micron, Nike, Rite Aid, BlackBerry. We do have, as we mentioned, even though it is the end of earnings season, we do have a few more big names coming. Keep in mind, earnings season does begin in the mid to end of October. So checking out this week, Monday, we have on the agenda Germany, the IFO survey, Fed speaks, and we also have ECB Lagarde speaking. On Tuesday, on the economic side for the US, we got durable goods, consumer confidence, and new home sales. Overseas, Japan, Bank of Japan minutes, and more Fed speak. Wednesday, more Fed speak, and the US international trading goods. On Thursday, we'll be watching the US GDP, Germany's CPI, Canada's GDP, and continuing Fed speak. On Friday, Fed speak again, personal income and outlays, consumer sentiment, and on the European side, you have France's CPI and PPI and the HICP flash unemployment rate in the Eurozone. So as you can see, members, every single day this week, we basically have some Fed speak. It'll be interesting to see what their commentary will be following recent market weakness and the FOMC announcement the previous week. Company events for the week, as always, we have shareholder meetings and analyst calls. Some bigger names on the shareholder side, we have General Mills, GIS with the shareholder meeting. And on Thursday, we have Intuit INTU with a analyst call. Pfizer as well on Monday. Top conferences for the week. If anyone, as always, has any questions or comments on this, shoot us a message via email or ask the desk, and we'll provide a breakdown if there is one available. U.S. economic calendar for the week. Pretty busy week this week. As you can see, filled a lot with red on Fed speakers. On Monday, we do have Fed speakers Collins, Bostic, and Mester speaking. Tuesday, Fed speakers Evans, Powell, and Bullard. On the economic side, we'll be watching durable goods orders, the home price indexes, consumer confidence, and new home sales. Wednesday, we have international trading goods on the economic side, and as always, the EIA petroleum report. Fed speaker-wise, we have Raphael Bostic, we have James Bullard, and Charles Evans speaking. On Thursday, watching this GDP number, and we do have more Fed speakers, Loretta Mester and Mary Daly. On Friday, we'll be keying on this personal income and outlays. As we mentioned, this has one inflationary report that the Fed does focus on, the PCE index. So we'll be watching that number, if any outcome in regards to an end of the week market volatility. We also have Chicago PMI and consumer sentiment. Friday as well, we do have Fed speakers Lyle Brainard and John Williams. Looking at the international economic calendar, we'll be watching on this side, not watching, but providing feedback or commentary. We do have Japan's Bank of Japan minutes. We have Germany's IFO survey on Monday and Germany's CPI on Thursday. So we'll be keeping a close eye on some European names, as well as Canada with their monthly GDP on Thursday. Earnings for the week, as we mentioned above. Tuesday, we have BlackBerry BB. That we'll be keeping an eye on. Thursday, Bed Bath & Beyond, CarMax, and Rite Aid. And aftermarket on Thursday, we have Micron and Nike. Fear and greed index, as we can see, the markets are in an extreme fear mentality. Clearly, with the market weakness, this is what we've expected to see on a weekend, fear and greed. Weekly sector performance, red across the board again. Second week in a row where it's clear red across the board. Energy this week took the biggest brunt of the hit, down about 10%, as consumer discretionary and real estate as well, down about 7.5%. Consumer staples, though, really didn't take that much of a hit, down 2.5%, as well as healthcare and utilities. Your indice comparisons, keep in mind, as always, we keep this. This is from the beginning of COVID. Markets are seeing a downtick back to those levels almost, as we can see in the Dow and on the Russell. So we'll be keeping an eye on markets this week to see if this week just continues or we continue to have a base out at support levels. Looking at your target rate probabilities, we are expecting, as of right now, on the 72% side of a 75 basis point hike, 27% on the 50 basis point. Your 10-year Treasury constant maturity at -0.51. Year-to-date returns, weakness continuing across the board in commodities. Nat gas down over 26%. The VIX, as we mentioned, breaking above that 30 level, saw an uptick of over 21%. Heating oil, one area that did see an uptick this week, about 3%. Gas down about 0.5%. Corn down about 0.5%. Wheat saw some strength. And crude oil, interesting enough, barely up this year, basically up about 5%. As always, we have our red on the bottom, and weakness continue to ensue, especially in your indexes. Your AAII investor sentiment survey. This was discussed in the news desk as well this week. A 60.9% bearish mindset on the AAII. I believe this is around 5 or 6 times only in the existence of this survey that we saw a break above this level. So the mentality across the board is on a bearish mindset. As you can see, the 1-year bearish high is this week. So we'll see how this correlates into the sentiment review this week in markets. Sector outlook, year to date. Energy utilities continue to stay green. Utilities barely green with only up 1.45%. We are seeing weakness continue across the board in all other sectors. One interesting aspect, we did have the 3-year turn negative on real estate and communication services this week as weakness continued in both those areas. IPO lockup expirations, we have RVSN on Tuesday and XPON on Wednesday. Expected IPOs for the week and your FDA calendar that is scheduled for the week on expectations. Now jumping quickly into some charts. A lot of people always ask us on this aspect of what we're looking on a technical basis, since it has been a very interesting technical market in our opinion. On the SMH, we added a new level support at the 190s level, testing June lows. So we'll be watching these June lows with a lot of charts coming up this week, keeping that mindset as a support level. So we did see basically complete reversal back to June lows on the SMH. Looking at the SPY daily, we added a new short-term downtrend for an idea of a possible move back up. 2 weeks ago, we mentioned to watch the 390 support, which was broken. Then we said keep a close eye on the 380s because this is a key level. Once that was broken on that downswing, we saw weakness ensue, and the S&Ps ended the week at 367.95, basically back to June lows again. Looking at your SPOI weekly, we added a short-term downtrend on a 2-week basis just to get an idea if the market is on a very short-term outlook or rather on a longer term. As we can see, these long-term trend lines that were broken, we saw that change in market thought process. So we'll keep an eye out if that is on an upside break. But other than that, we made no changes to the chart, and it did test that support level of June that was already on the SPY weekly chart. Looking at your SPX daily, this is on the S&P. As you can see, a hammer candle on Friday on the SPX, basically breaking all support levels, all moving averages to the downside. So we'll be watching this level support as a key indicator of possibly a base to be built or a bounce to the upside. If we can see that break, we can easily go back to that 3,400 level on the S&P. Triple Qs daily, as you can see, moving averages all negative across the board. That trend line break that was there from previous weeks was broken and weakness ensued. IWM daily, same mindset. Market saw the moving averages, that uptrend broken, weakness ensued. Looking at your 10-year yield weekly on a more broad basis, goes back to 96. So we are seeing these levels back from 2008-9. We'll be keeping an eye on these levels with that upside 4% break. Could see a move to 5%. Charts for the week additionally on a 10-year yield weekly. So no changes to this chart, members. This is a pure technical move on your 10-year yield. This is probably the 5th week in a row where we said this is a pure technical move, as you can see in the notes. One of the key indicators outside of the US dollar that we believe has been the clear indicator on the directional move for markets. Last week, we tested that resistance, a pure test with an upside break, and we saw new highs. Uptrend still clearly intact. We'll keep an eye out if this is ever broken for a possible downside move. IWM weekly, we added a downtrend as well as a new level support on the IWMs. We added these downtrends in a lot of charts to get an idea if we see a small bounce or a rally on this technical mindset if these are broken. We'll keep those updated throughout the week and into the following weekend webinar. HYG weekly, as you can see, this goes back as well to 2005. These levels have not been seen. And we did see that drop in 2020 with the COVID drop, but we're going to keep an eye out, if this level is supported or we are seeing continued weakness. The diamond daily, broke the June lows and formed a hammer candle on Friday. So we are watching the diamonds. We do have these a few little gaps much lower. So we'll be keeping a close eye on those going into this week and the week ahead. Your VIX weekly, looking at a little a curvature here. We broke that 30 level. We are watching that 35, the mid 35 40s of that resistance. If that is broken, you could see one of those quick spikes, members, of the true fear of possibility. Excuse me. Looking at your oil daily now. We added a new support level at the 75s level, as well as 2 new downtrends for any upside move. Last week we mentioned 80 support. Once that 80 support was broken, we did see a downside move to 78.04, but closed right back by those 80s support numbers. When we mentioned 80s, members, we mentioned a plus or minus. That's why we put the 80s there. So we'll be watching the crude oil this week on any indication of an upside possible move if these downtrends are broken, or if a base is being built at the 80s or trading down to that 75 level. US dollar daily. This is a chart that screams bullishness. We did see that volume pop to the upside. We added short-term uptrends in case for a downside move that we'll be watching. Since this is a daily, we could see that adjust very quickly. It looks very similar to the 10-year yield chart. As we've always mentioned, members, we focused on 2 areas of this market. We focused on the US dollar and the 10-year yield on an overall indication of market activity. And as we've seen, with the strength in the dollar and strength in the yield, the markets did retest June lows. So we'll be watching this clearly moving forward for any indication in US markets. Bitcoin. Sorry about that. Looking at Bitcoin, no change to this chart. With recent volatility in markets, it feels like crypto and Bitcoin especially have lost their umph. Not many headlines on Bitcoin and not many circulations regarding crypto. So we are watching this Bitcoin daily chart. Clearly, this downtrend continues to be in play, trading below that 20,000 support level. If we see that upward trend, keep in mind, members, this continues to move closer and closer to that 20,000 mark. So we'll be keeping an eye out on Bitcoin in regards to any indication in regards on that upside break or a continued lower to keep that downtrend in play. So that's basically what we're looking at when it comes to the market for the week. It's going to be a very busy week, members, on the Fed speak side. As we've seen, we have speakers on a daily basis throughout the week. And right now, we'll just scroll it back to the calendar. As you can see, Fed speakers throughout the week. It'll be interesting to see their commentary. As always, we'll post that in the news desk. We're going to go radio silent for a few. If anyone has any questions, just shoot them in the chat box. So someone asked if we would ever do a technical analysis webinar. Yes, members, if our members would want it, we'd be more than happy to do it. If anyone has any questions on that, shoot us an email. We'll send out some sort of a survey in the next few weeks. And if our members are interested, we'll be more than happy to give you a more breakdown, detailed view on the markets, as well as if anyone has any questions regarding individual stocks, we'll be more than happy to do a webinar on that. This is what we're here for. We're here to help out, especially in these kinds of environmental in the markets. The other question is, what are your thoughts on inflation in the Fed? As we mentioned, in the past, we look at it as a U.S. citizen, I guess you can say. We are always, on the unbiased side in regards to our content and information. So we view it as how the everyday citizen does. And what else can we say? But things are expensive. You go out to dinner, you're spending $50 to $100 per person at certain places. Compared to $50, $100 for two people. So we are seeing a lot of moves to the upside regarding prices. And when it comes to the Fed, listen, our thought process is what it was years ago. The fact that the Fed continued to pump money into a market that didn't need it. Now, the question comes down to how far would they go, taking that money out of the market and increasing rates. At the thought process is the Fed mindset right now is very hawkish, and we have to adjust. You adjust your mindset in this business, and if you don't adjust, you could basically see a lot of damage to a lot of portfolios. So in our mindset is you adjust to the Fed, because right now the mindset is on a hawkish raising rate environment, and many have not experienced that. But as always, we recommend doing due diligence on all your trades, all your investments. And like we said earlier with Peter Lynch, do not fall in love with stocks, because basically there's thousands out there to play, headlines all day, and momentum has been continuing in regards to certain areas, in regards to IPOs, relative strength, not relative strength, correction, reverse splits. So the momentum is out there on markets, headlines are out there, and our mindset is just to adjust for now, just like we had to adjust in the past for a easy monetary Fed mindset. If anyone has any other questions, we'll go silent for a few, and then we'll wrap it up for the day. So once again, I want to thank everyone for joining us this weekend on our weekend webinar. This is recorded, so we'll be posting it in the news desk, as well as shooting it out there via social media. I want to thank everyone for joining us. Enjoy the weekend. Enjoy the rest of the day. See you Monday morning on the TradeXchange pre-market prep. Thank you all. TradeXchange out.